Welcome. I'm Gregory Saxton, professor of accounting at the Schulich School of Business and co-director of Schulich Centre in Digital Financial Information, which is generously supported by CPA Ontario. We're excited today to bring you another webinar by Dr. Peter Kipp, who is a CPA and a professor of accounting at the University of North Texas in Denton. And what he'll be talking to us today about blockchain fundamentals for accounting. So thank you for joining us. And Peter, welcome.
All right, thank you so much, Greg, and thank you all for joining me this afternoon. I also would like to thank York University for hosting me, and the Schulich CPA Ontario Centre and Digital Financial Information, and CPI Ontario for inviting me here today. So I want to talk about something that almost everyone's heard a lot about. Some people probably have a basic understanding, but want to drill down into what blockchain is and what it means for us as professional accountants and how it could potentially be transformative to the profession. So my objectives today is I want to define and describe the underlying technologies of blockchain. So blockchain itself is a very sophisticated combination of technologies that have existed for several years. And I want to describe how those technologies work and interact to enable the blockchain. I also want to describe some shortcomings of blockchain. So when blockchain first really hit the business popular press about 10 years ago, there was a lot of hype that it was going to transform everything. It was going to be the best thing that ever happened since Benjamin Franklin discovered electricity. Obviously, those expectations have been watered down a bit. We sort of understood some of the limitations, but I want to describe those shortcomings as well. Give just a few examples of current and early adoption of blockchain, so how it is being utilized in practice, and then maybe most interest to you, some considerations for adoption within your organization. Do I need a blockchain, or how could a blockchain potentially benefit me? So to start, what is a blockchain, or what is blockchain? And I guess it really depends on who you ask. So I've taken a lot of different clippings from the business popular press. So New York Times, is the blockchain just hype? Blockchain data is the next big thing from Forbes. Offers a sweeping vista of opportunity to reimagine how the financial system can and should work in the internet era. And a couple of my favorites: blockchain technology will revolutionize far more than your money. It will change your life. It is that transformative that it will change your life. Blockchain technology is the most significant invention since the internet and electricity. And then there are, of course, some detractors. There are no good uses for blockchain, and one of the most overhyped technologies ever. So before I talk about blockchain, I want to talk about why blockchain was originally, I guess, formulated or developed with Bitcoin. So Bitcoin is the most popular cryptocurrency out there and needs blockchain to survive, to essentially function. So how did Bitcoin come into being? So let's suppose I want to transact with someone online. I want to transact with a seller, but I don't necessarily trust the seller, right? If I give them my credit card information, they could potentially steal it, make off of it, make purchase on my credit card. That doesn't make me happy. I don't want that to happen. And it's possible that I may want to keep my identity anonymous. I don't want to necessarily have the seller know who I am as an individual. I just want to give them the requisite information to complete the transaction. So today, how do we solve this problem? Well, we exchange through intermediaries, right? So we have PayPal, we have Venmo, we have several other intermediaries that we transact through to deal with people we don't necessarily trust. And we can even keep ourselves a little pseudo-anonymous, potentially, may be able to protect my identity from the seller. However, this results in an inefficiency, right? So even though I have increased trust or increased assurance that I won't be bamboozled, I can't exchange directly with the seller. I have to do it through an intermediary. So there's a loss efficiency there. Well, what's more efficient? What could be more efficient? And the obvious answer is cash. Everybody loves cash. Cash is king everywhere. So I can pay in cash, totally anonymous. Nobody needs to approve the cash. No need for approval from a third party. However, with online transactions, cash is not very convenient, right? So if I had physical cash, I'd have to physically mail it to your address. So not nearly as convenient as credit cards, And the second issue, let's say I have virtual cash. So if I have virtual cash, they could potentially be spent more than once. So this results in the double spend problem. Right. So if I have a digital coin or a digital dollar, let's say a digital $100, and I want to transact with Lisa, I send Lisa $100, but then I make a copy of that token or that coin and I send it to Alice. Now, Lisa has no relationship with Alice. Alice has no relationship with Lisa. They're not communicating. They don't know that I've already spent it, that it's not valid. All right. So what's the solution here? What's the solution to the double spend problem that world banks have come up with? And it's simply a unique serial number, right? We create a unique serial number for each virtual dollar so we can trace it and have assurance that it hasn't been spent multiple times or spent multiple times by the same individual. But then getting back to blockchain, supposed to be distributed, decentralized, we arrive at the problem, who's going to issue the serial numbers? Who's printing the money? And the answer is a central authority. So for example, the Bank of Canada. So how do we get around all these problems? With Bitcoin, it solves the problem of anonymity. So I can transact anonymously online, don't need to give you my identity. I can transact directly with individuals, and I do not have to transact with a central authority or a centralized bank to approve transactions, all direct. And Bitcoin does this by blockchain. So blockchain is the underlying technology that allows all of this to work. So blockchain, simply put, it aggregates transactions into a block and chains them together. So it's a distributed ledger where everyone has a record of every transaction ever made. So you could, there's several sites that track the Bitcoin blockchain. You can go there right now and you can see in real time what is happening. So anyone can participate. It's permissionless and everyone can sign up. And it aggregates in blocks in an append-only ledger. So I can only add to existing blocks. I cannot change or edit anything that's already been essentially put on the blockchain. So the original idea, it's not a new idea. It comes from Haber and Stornet in 91. So the secure timestamping of digital documents, where each certificate, the timestamp, ensures the validity of the transaction. Now, the beauty of blockchain is it combines several existing technologies. For example, public private key, asymmetric encryption, cryptographic hashing, distributed ledgers, and peer-to-peer consensus. And together, this enables the Bitcoin blockchain and blockchain in general to operate. So first, let's talk about asymmetric encryption. So suppose we have two parties. We have Alice and we have Bob. Why is it Alice and Bob? I don't know. That's just what computer science decided long, long ago, that we're going to call two parties, A, B, Alice and Bob. So Alice and Bob are on the same blockchain, and they both have a public and private key pair. So, for example, if Alice wants to transact with Bob, she would use her private key to sign a message. She shares her public key with everyone. She has her public key. Bob has her public key. Carl and Daryl. Everyone has her public key. So she broadcasts a message. I want to send $100 to Bob. And that message is sent to everyone on the network. Now, there's four conditions for this. The asset has to be valid, so it has to exist, right? It must not have already been consumed, so the double spend problem. The value that comes in must be the same that went out, so deduct $100 from Alice's wallet or account, add 100 to Bob's account, and then the transaction is validly signed by the owner's private key. So if Alice will take all this information, subtract $100 from my wallet, add $100 to Bob's wallet or Bob's address, and then I'm going to sign it with my private key. And that signature can be verified with her public key. Who has her public key? Everyone. So everyone can verify that, yes, this is a legitimate transaction, and it was sent by Alice. So signing the transaction metadata with the private key, everyone can see, including Bob, that it was signed by Alice, verify it with the public key. It's a legitimate transaction. So let's say that Alice wants to change it. She wants to change the transaction. Instead of giving $100 to Bob, she wants to give that $100 to Carl, right? So she wants to try and game the system and spend the same $100 twice. So Alice is prevented from doing this with the cryptographic hash function, right? So there's a unique Bitcoin or $100 address with that's hashed. And in order to change the transaction, she'd have to subvert the cryptography, essentially hash it. So how this works is Alice takes the metadata associated with her transaction. So the origin wallet, so it's coming from me or Alice, the destination wallet going to Bob, the amount being sent, the timestamp when it's being sent, and then her signature. So her signature with her private key. All that is sent out and it's hashed. And all cryptographic hashing it's a very sophisticated algorithm with a lot of math that I unfortunately am not intelligent enough to explain. But it takes an input of any length and generates a unique value of a fixed length. And we take that for every transaction. And then we take those hashes and we concatenate them. We concatenate the hashes together, and we take a hash of the hash. And we keep going until we have what's called a root hash, which is a hash of all other hashes. This is referred to in cryptography and computer science as a Merkle tree. And the root hash is referred to as the Merkle root. So it's the hash of all hashes. So for example, I went through a hashing algorithm. So SHA 256, which is just secure hashing algorithm 256. And I put in, Alice sent $100 to Bob at 14:25 today. And the resulting hash we see here, we got the 64 character output. Then I have transaction B where I say, well, Carl's going to send $200 to Daryl. And again, I have the hash of output of that below. Then I concatenate those two hashes. So I just append them together and I have 128 characters. And then from that concatenated hash, I take a hash. I know I'm saying hash a lot, right? So now what if Alice wanted to change the original transaction? So again, she originally sent $100 to Bob. What if she wants to send it to Carl? Well, I hash this metadata, and this is the resulting hash. I concatenate that with the B hash from before and hash that. This is the updated concatenation versus the original. And you can see that it's obvious something has changed. So this is referred to as tamper evidence. So it's obvious something has changed. We're not necessarily sure what it has changed, because for the hash function to operate correctly, it can't be decrypted. I can't go back and see what the original input was, but it's obvious. And because we have this Merkle tree where we continuously hash and concatenate, if any information anywhere within any of these transactions is changed, it's going to flow down to that final hash, that Merkle root. So that's referred to as an avalanche effect. So it becomes obvious if someone has changed anything within the transaction data. So for cryptographic hash function to properly operate, it needs to have three properties, so three conditions. And these come from cryptography. So the first is collision resistant, where it's infeasible to find two values that result in the same hash. Now, it's a mathematical certainty that there are multiple inputs that result in the same output, right? Because SHA 256 and other hashing algorithms take an input of any length, 1 character, 2 characters, the entire text of Moby Dick, the history of China, all of that, and it'll always result in an output of 64 characters. So we have an infinite input space, but a finite output space. However, SHA 256 and others have been proven that even using today's computing power to brute force hack, it would take, I believe it's on the order of millions or billions of years to find a collision, to find two inputs that result in the same output. So SHA 256, SHA 512 are both collision resistant, where if X, the inputs are not the same, but the hashes are the same, that would not be collision resistant. Also has to have the property of hiding. So hiding suggests that given the hash of a nonce, where a nonce is just a number used only once, so a dummy value, for example, in a message, it is impossible, or excuse me, infeasible. It's possible. It's always possible, but again, millions or billions of years, nobody has that kind of time. It is infeasible to determine the message. So this just suggests if I know the output, so I know the hash, I can't decrypt it to know what the original message was. So can't decrypt the hash. And the final one is puzzle friendliness. There is no strategy better than trying to find random values to solve for the nonce. So this means that individuals just have to continuously guess in order to find a specific cryptographic hash. And this is important for the Bitcoin blockchain. And I'll talk about that in a bit about why. So once the transaction is out there, it is sent to all nodes. So Alice sends Bob $100. So what's the data? $100 deducted from Alice, $100 added to Bob, sent at this time, and then signed with Alice's private key. So in a centralized network, that would originate at one node and be sent out. Decentralized, it could be originate several different nodes and sent out from there. Here, with a distributed ledger, any node can communicate with any other node. So all nodes are sharing the same information. On the Bitcoin blockchain, they're all sharing the same information in the distributed ledger. So this leads us with the distributed consensus protocol. How do we verify that this is true, that it's honest? So there's something called the Byzantine general problem. So it's a classical fault tolerance problem or an impossibility result. And the story goes that the Byzantine army has surrounded the city. I don't know why it's the Byzantine army. Somebody met somewhere and decided that's what they were going to call it. But the Byzantine army is surrounding the city and they're going to attack. But in order for the attack to be successful, they have to coordinate, right? So they have to be able to coordinate their attack, communicate with each other. Now, it's possible that some of these generals or there's individuals in the army that are traitors. They're going to try to subvert the attack and sabotage it. It's possible that some of the messengers being sent between generals forget the message or don't make it in time. So Byzantine general problem has shown, it's proven that a system will fail. So consensus will fail if 1/3 or more of the generals are traitors. So in blockchain, what that means is if 1/3 or more of the nodes are dishonest, we won't be able to reach consensus. The system will fail to operate. So the protocol has to have two properties. It has to terminate with all honest nodes in agreement on a value. So all honest nodes have to say, yes, we agree that Alice sent Bob $100, and the value must have been generated by an honest node. But previously, what does honesty mean? Because we don't have perfect information. We don't know who is honest. We don't even know who the identities of these nodes are. So it's impossible to know which transactions are morally legitimate. So we have to incentivize honest behavior. So we incentivize honest behavior with mining in the Bitcoin blockchain. So you've probably heard of miners are mining on Bitcoin blockchain. Those are the individuals or the nodes that are involved in consensus to verify that, yes, this is a legitimate transaction. It should be added to the blockchain. So how does that work? So when Alice transacts with Bob, she sends that message out to every node on the network. So the transaction's broadcast to everyone, but it's not formally added to the blockchain yet. It's unconfirmed, and it's stored in the node's memory. So this could be thought as like a pending or maybe a hold on an account. Need to verify it first. So it's not formally confirmed yet, but everyone has the same information. Then each node is going to collect these transactions. So the transaction metadata origin address, destination address, the amount, time, signature, and they're going to put it into a block. This is where a blockchain, so we're aggregating it into blocks. Now, each node aggregates the transactions in their own block, different blocks. It's not the same block. They get to determine what transactions are in each block. How does the node determine what transactions are out of the block? Well, it could simply be first in, first out. So this transaction occurred first, or the timestamp was earlier, so I'm going to add it now. Individuals are adding a transaction fee associated with their transaction. So if Alice wanted her transaction to clear sooner, she could say, oh, I'm sending out $110 and Bob gets $100 of that. Well, we can't create or destroy value. Where's that other $10 going? That's a transaction fee. Whoever solves the block gets to determine where it goes. And most of the time, they're going to say, oh, it goes in me. It's my pocket. This is my reward. Thank you very much. So each node aggregating transactions into a block. And then the system in each round, it says, okay, a random node gets to broadcast its block to the entire network. And the randomness in the Bitcoin blockchain is proportional to some scarce resource. So Bitcoin blockchain is a proof of work system. That scarce resource is computing power, and by extension, electricity. So the Bitcoin blockchain uses a hash puzzle to proxy for computing power. So, for example, the system may say, I need to find a nonce. So you have everything aggregated, all the transactions. You have that Merkle root. Well, now find a number that you can concatenate or add to that, and you hash those two values together, and it results in, let's say, a hash with 19 leading zeros. So this was taken from the Bitcoin blockchain a couple days ago. It has 19 leading zeros, and this was the nonce. So this was the random number that ultimately resulted in this hash. So this is the hash of the previous hash, so of the previous block, plus the Merkle root, so the hash of everything in my block, plus the nonce equals the current hash. And then the first one to solve it essentially wins the round. So then they broadcast this out to every other node. And the other nodes indicate their acceptance by adding it to the blockchain. So the other nodes have the same information. All the transactions were sent out. They should be able to easily verify that, yes, this is true. This is unspent Bitcoin. These are valid signatures. And they're only going to accept it if that's valid. So they express their acceptance by then adding it to the chain. And then that current block in the next round, it becomes the previous hash. So we're adding to the longest chain. So my incentive to behave honestly or perform honestly is I want everyone else to accept my work. And they're only going to accept my work if they believe it's true as well, if it's valid. So then, if I win the round and everyone accepts it, I get paid, right? So honest behavior is incentivized, other nodes accepting the block. Then I can also add the Bitcoin reward. So every block currently mined, you get a 6.25 Bitcoin reward. And as part of your current hash, you get to decide which wallet that Bitcoin goes in. And guess what? Most people choose their own wallet. So they add it to their own wallet. And then the fees. So if I'm paying Alice $100, but I have more than $100 going out, where's that extra money going to go? Well, that extra money, whoever solves the block gets to determine where it goes. They usually choose themselves. So some properties for the distributed consensus protocol. It must be difficult to compute. So this is the same as puzzle friendliness. So the Bitcoin blockchain, it varies based on how many miners or nodes are trying to solve the hash puzzle, but it's approximately 269 exahashes a second. So this is 269 quintillion hashes generated by all miners on the Bitcoin blockchain per second. And it takes approximately 10 minutes to solve the hash puzzle, for the entire blockchain to solve the hash puzzle. So we extrapolate all that in order to essentially hack the system. I think I did the math earlier. It was 4 times 10 to the 60th power. I don't know what number that is, but it's really, really large. So infeasible to hack. Also has the property of parameterizable. So all this means is it recalculates the difficulty of the hash puzzle every 2016 blocks. So to try to keep the block generation constant at 1 block every 10 minutes. There's nothing magical about 10 minutes. It's just enough lag so that everyone on the system is able to update and have the same information. And parameterizable just means, well, if we have fewer miners and we have less computing power, we're just going to make the puzzle easier to solve. Whereas if we have more miners, more computing power, we make it harder to solve. And then finally, it's trivial to verify. So once I have the nonce, I can easily add it to my hash and say, yes, I agree, or no, I do not. So there's several other consensus protocols. One of the biggest criticisms of the Bitcoin blockchain is the energy consumption with that it that accumulates with the computing power. So there's proof of stake, and this avoids the energy expenditure. What it does is it randomly assigns block leadership. So again, you want to be the one to propose your block because you get rewarded. So it assigns block leadership proportional to their stake in the system. The idea being that the larger your stake in the system, the more incentive you have for others to behave honestly. But it's vulnerable through gaming, through forking, and we'll talk about that with 51% attacked. Proof of elapsed time. So nodes are required to wait for a randomly determined time period. So there's a code, a trusted code, that randomly assigns a sleep period to each node. And the first node to wake up is the winner, and they get to propose their block. So this one is nice because it saves a lot of computing power, right? So you're not mining, you're not trying to solve for a very difficult hash puzzle. You're just sleeping on the task. Your computer can use that processing power to perform some other task. Proof of importance is similar to proof of stake, but it discourages gaming by assigning block leadership proportional to participants' activity. So their number of transactions, the amount spent, etc. Again, the more active you are on the system, the theory is the greater your incentive to behave honestly. And then there's others, proof of activities one, which is a hybrid of proof of work and proof of stake. So now that we have a basic understanding of the fundamental technologies underlying blockchain, is blockchain invincible? And I will say this, the Bitcoin blockchain itself, the code and the cryptography underlying the Bitcoin blockchain has never been hacked. Yeah, so is it possible? Yeah, it's possible in theory, but it hasn't been hacked yet. There have been hacks of Bitcoin, but I'll talk about those in a bit. So Bitcoin blockchain is theoretically vulnerable to a 51% attack, right? So if I control 51% of the network, more often than not, I'm going to be the one that proposes the next block, propose what transactions clear and are posted. Now, in theory, this won't necessarily happen because if I know that someone has a majority power or has a majority stake in the system, it loses its value. Right? If it's trustless and they have a majority, well, I don't trust them because they could potentially override whatever I say and benefit themselves. So these 51% attacks typically target smaller cryptocurrencies and require what's referred to as a hard fork. So again, acceptance is I use the hash of that block in my next block. So a hard fork would be, oh, I know that these blocks are part of a 51% attack. So they're essentially fraudulent. And if I know that, then I can go back and I would just try using the hash of the block that I believe, most recent block, that was legitimate. And that's the fork where you have two branches. Transactional malleability. So this refers to sending out multiple transactions using the same asset in quick succession and trying to see sort of confusing the network into accepting multiple of them. So with the cryptography, the input address, the output address, the asset, and the signature can't be subverted. So you can't change the transaction semantics without subverting the cryptography. And we've discussed that it's infeasible to hack the hashing algorithm. But you can make amendments to the transaction ID or the hash, and you can try sending it out. And if the amended transaction is accepted by the network first, it's possible the original transaction won't be accepted, and you could possibly double spend. Most often, where blockchain has failed, it hasn't actually been the blockchain itself. It's been compromised private keys and code vulnerability that exists on top of the blockchain. So, for example, Mt. Gox and Bitfinex are were two of the largest Bitcoin exchanges that happened to be hacked. How were they hacked? Well, they just stole someone's private key, right? So the private key is how we verify that it's a legitimate transaction, how we verify identity. So if I steal Alice's private key and I say, oh, Alice is sending all of this Bitcoin to me, everyone else on the network doesn't know any better. It has Alice's signature, so we assume it's legitimate. They're going to say, yes, this is true. We agree, and post it to the blockchain. The Ethereum decentralized autonomous organization was a little different. This resulted in a hard fork where there was sort of like an IPO. People bought stakes in the DAO, and then proportional to this stake, they had voting power, what the organization would do and how it would invest. And what happened, there was a code vulnerability where they were able to drain the Ethereum from it, resulted in a lot of controversy and a hard fork from what was referred to as Ethereum Classic. So in theory, the Bitcoin blockchain is not invincible, but it's darn hard to hack. And where it has failed, the blockchain itself hasn't failed. It's been either private keys, I lost my key and someone was able to get into my house, or poor code. So why are we as professionals interested? So with an immutable append-only ledger, gosh, why would we with financial transactions want that? So audit, obviously very interested in an immutable audit trail, being able to go directly to an asset provenance. Financial services decrease settlement time. So if I have one source of the truth, I don't have to go to multiple sources to, for example, are there liens on this property? Do other individuals have claims? You actually have an ownership interest? Stuff like that. Tax authorities are very interested. So it's an immutable ledger. So employers reporting directly to the tax authority. Well, now I have essentially perfect information and I can calculate your tax liability, cut down on tax evasion and fraud. Supply chain management, record of asset provenance. So this has been already used for product recalls, specifically with produce, E. coli outbreaks, being able to trace infected product back to the farm or the plant it originated at, and then I can only have to discard or assign to spoilage that product that originated from the farm and not every, let's say, head of lettuce in my store. And then also smart contracts using if-then Boolean logic to execute code once performance obligations have been fulfilled. So, and I'll talk about that in a little bit. So some examples of blockchain in practice where blockchain is already being used. So Walmart has been an early adopter. First, they had a prototype blockchain to identify foodborne illnesses originated in supply chain. So they had a team, and I think an executive went to the store, picked out an orange and say, hey, tell me where this orange came from. And the team, I believe with their traditional ERP system, was able to locate its origin within a week. With a blockchain, they were able to do it in about 1 minute. So obviously that's a huge time savings. If there was a product recall, that time could save us a lot of money on spoilage and discarding product that isn't compromised. And then automated processing of invoices and payments to 70 carriers. So 70% of invoices for Walmart required reconciliation. Now with blockchain, that's been trimmed down to less than 1%. So huge efficiency, increase in cost savings there. NASDAQ has a pilot, Link, where they had pre-IPO trading on a private market. So they have private exchange that's run by a blockchain, and with some ambition to turn this into a public forum, but they're not quite there yet. One of the more interesting examples is humanity.co. So they their vision or their mission statement is they want you to control and sell inherent human data. And they define inherent human data just as data we generate by living our lives, right? So my heart rate is inherent human data, my weight, my eating habits, my geolocation, where I travel, how fast I travel, sleep, all that's inherent human data. My internet browsing habits, right? Where some of that is collected with our consent. We have to agree to those end user license agreements. We have to agree to those terms and conditions. Their thought is, well, with a blockchain, you could have all that information aggregated there, and then you could potentially sell it to interested parties. And of course, then humanity.co would collect a small fee. And then again, one of the big successes of blockchain has been IBM Food Trusts, which is an immutable shared record of food provenance, similar to what Walmart did with their prototype, and being able to trace products directly back to their source. If there is a recall, if there is an E. coli outbreak or some other disease spreading, quickly identify what product has been compromised and discard of that, while keeping the product that is good on the shelves for consumers. So now that we have seen some examples of blockchain, why hasn't everyone adopted blockchain? Why isn't everything on the blockchain right now? So with the Bitcoin blockchain, there's some shortcomings. It's very inefficient, and the proof of work consensus isn't scalable. So the Bitcoin blockchain currently processes about 3.3 to 7 transactions a second. So each block, there's no upper bounds on how many transactions can be in each block. Each block is posted about every 10 minutes. And it's only limited to the amount of data in there. I think it's limited to 1 megabyte of data. But that gets you about 2,000, 2,500 transactions every 10 minutes. Visa, on average, processes 1,700 transactions a second and could process upwards of 24,000. They claim they could process 24,000 transactions a second. Also, the proof of work consensus, while brilliant in a trustless environment, consumes a lot of energy. So 150 terawatt hours annually. That's the same energy consumed as the entire country of Argentina. Argentina is not a small country. There are alternative cryptocurrencies that are investigating different consensus mechanisms to try to address some of these shortcomings. The second shortcoming is the Bitcoin blockchain is permissionless. So anyone can join, anyone can participate as a node, anyone can transact, anyone can be a miner, right? Now, most organizations don't allow me access to their ERP system. I can't imagine why, but they don't want me snooping around. So in business, most organizations are probably going to adopt what's called a private or permission blockchain, where blockchain membership is selective. You're either invited, or new members are invited only after a majority vote. Now, this is vulnerable to the Byzantine general problem. You could accumulate power in some nodes. And again, if 1/3 or more of the nodes are dishonest, then the system fails. Side deals, obviously, there's no presence on the blockchain, so I wouldn't have complete information. And then regulatory requirements. So there's several industries, especially the financial services industry, that need you to comply with anti-money laundering laws and know your customer laws, regulations. So we can't have people transacting anonymously, like the Bitcoin blockchain. We need to know who we're dealing with. So the Bitcoin blockchain was designed to be trustless, record assets that are only on-chain. So Bitcoin is only generated by the blockchain itself, by the system and its code itself. Nobody else is generating Bitcoin. And it's pseudo-anonymous. Now, in practice, these are not necessarily desirable. Trustless, assets that are only on-chain, and pseudo-anonymous. I want to know who I'm dealing with. I probably want to have some modicum of trust that they won't harm me, or assurance they won't harm me. And most assets I'm dealing with exist in the real world, either physical assets or fiat currency, stuff like that. So how do we solve these problems for actually adopting a blockchain for a business? So to solve the problem of trust, you could create what's called a smart contract. So smart contract is just a written agreement, is an agreement written directly into lines of code. So why do we have contracts? Well, because we're afraid that someone could perform outside their assigned duties, the traditional management agency problem. So we want to describe, okay, this is what's acceptable behavior. After you complete X, I will give you Y. Same thing here. Oh, excuse me. So it can act as an escrow account where once a condition is met, the code executes and it releases funds to the individual. So, for example, with FOB, freight on board shipping point, once items are on board, the seller's obligation is complete. They can recognize revenue and they're going to want to collect payment. So the smart contract, if it recognizes that the goods are on board the carrier and the obligation is complete, they'd execute the code on the blockchain and release payment. The problem here is that smart contracts are on the blockchain, and the blockchain cannot interact with the real world. So it can't interact with data or systems that are what are called off-chain. So this leads to the blockchain oracle problem. So an oracle is anything. It could be a sensor, could be a camera, other electronic devices. It could be an individual manually inputting data. So an oracle facilitates communication between blockchains and any off-chain system. So anything that exists on the internet or in the physical world. So using the previous example, an oracle could read radio frequency identification tags of the associated product once they're loaded on the truck, and maybe have a geolocation and show, oh, the truck is moving. So yes, now I can release funds. So these could be Internet of Things sensors, APIs pulling data from the web, or RPA processes. And Mark Sheldon has a couple of really good papers out there talking about blockchain and how to solve some of these. He argues that oracles are simply analogous to service organizations, that they provide some assurance that, yes, this information is true and accurate, or complete and accurate. Excuse me. So some consideration. So this starts to become, okay, well, now I'm going to have to articulate some control objectives around these oracles and gain assurance. So does the oracle provide complete and accurate data? So how do I trust it? Well, an oracle could be an API pulling data from Bloomberg, for example, so financial data from Bloomberg. Well, generally, we trust Bloomberg is going to have complete and accurate data. So maybe I don't need a high degree of assurance there. But if it was pulling from maybe some lesser known sources, then maybe I need to gather some greater assurance that it has complete and accurate data. How do I gain provenance or assurance over the provenance of goods? So how do I know that where these goods originated from? So this is important when dealing with like conflict minerals, or with food articles, as we previously said, with like E. coli outbreaks, and other fair trade certifications. And then how is appropriate consensus determined? So how do participants in the blockchain say, yes, we agree that these items were loaded onto the truck, that the items were what the buyer ordered, and they're on their way. Next, how do we solve the problem of physical assets existing on a blockchain? So this is solved with NFTs, or non-fungible tokens, which I'm sure many of you have heard of. So again, the Bitcoin blockchain, Bitcoin is only generated by the blockchain, and it only exists on the blockchain. I cannot physically withdraw Bitcoin from a blockchain. Now I can have it in my wallet, and I can put the code of the wallet on, let's say, like a flash drive or a hard drive somewhere, and remove it from the internet, but I can't physically extract Bitcoin. So how do I represent this in the physical world? We do this with tokens, or non-fungible tokens. And we've already do this a little bit when we try to, when using machine readable data. So with barcodes or RFID, there's metadata encoded in those associated with the product they're affixed to. So barcodes, the product name, the price, maybe the batch number, manufacturing date. RFID can hold a lot more information than that. So very similar. So attaching an RFID or a barcode to the product with the information that will also exist within the NFT on the blockchain. Now, the considerations here are who is responsible for minting new NFTs. So who is responsible for adding an asset to the blockchain? And how is consensus reached for that? How do I verify asset existence ownership? So again, how do I verify this asset exists in the real world and that the individual has ownership? How is consensus reached that the NFT should be added to the blockchain? So again, these are considerations that you would want to have answers to before adoption. So, and I want to end with just some recommendations, again, from Sheldon 2002. He has 4 stages for blockchain implementation. We're implementing a blockchain with real world physical assets. So the first is a consortium charter. So like any other agreement or any other shared governance, we want to formally define the rights and privileges of each participant. So on the Bitcoin blockchain, everyone has every permission. I can transact, I can read only, I can view items, and I can mine. We don't necessarily want everyone to have all those permissions. So who has the right to verify the occurrence of transactions? Who's going to do that? Who's able to submit transactions to be recorded on the blockchain? Who and how do we validate transactions and participate in consensus? So how do we verify that, yes, this happened? And it could be that, hey, maybe we have a camera. So maybe we have cameras in a warehouse, and that's how we're going to verify movement of goods. And then who is the one that maintains a copy of the blockchain and who's able to view it and look at the immutable record? Step 2 is asset creation. So when asset's created, what identification tag is attached to the asset? What information is in that identification tag? How is the creation observed by participants or oracles? We got to reach consensus. How do we do that without any evidence? And then the attributes assigned to the NFT and the NFT minted. And who mints the NFT? So what do we want to record on the blockchain within the token? And then who's the one that's ultimately responsible for minting the new token or adding the asset to the blockchain? Asset transfer previously was shipping. So how do we validate transfer of the asset? Could be with RFIDs and oracles. And will smart contracts assist in the transfer? So once assets are transferred, is the code going to automatically execute and pay the seller? And finally, asset retirement. So when should a token be burned? And burn just means sending the token or the digital representation on the blockchain to a wallet that nobody can access ever. So it's essentially destroyed. And then how do we verify that? So my last slide, these are some of the sources that I drew upon to prepare this presentation. If I piqued your interest, I'd encourage you to seek out these sources and read a little bit more. But thank you so much for your interest in blockchain. I hope you found the presentation informative, have a better understanding of it, and I'd be happy to answer any questions.
All right, thank you, Peter. It was very fascinating webinar. Thank you very much. And so, Peter, go ahead and ask him questions, and you can put them. Start firing away. It looks like you have a bunch. Somebody mentioned something about Oxion said to protect the consumers. I think the involvement of regulatory is one of the important elements. Not a question, but it's something. I don't know if you have any thoughts about that. Greg asked a question about hash variants as well. I'll put in the chat.
Yeah, so when hash variance is discovered, so if the hashing algorithm is acting as it should, it's impossible to go back and pinpoint. I would just have to go to all the transactional information contained within it and then go through each one until I find what's wrong, right? So it'd be the same with like a contract. So if I change the terms of a contract, let's say I have a student mow my lawn for $30 a week. I probably should do that. That would save me a lot of time. I don't, but I change it. They go in and change it to $50 a week. And I put it through a hash and I see, oh, the hashes don't line up. So I don't know what it is within the contract they changed. It could be they just added a space, right? So, or it could be a typo. I would just have to go through, skim through. It's like, oh, you changed how much I'm buying you, or how much I'm buying you, how much I'm paying you. That's a no-no. We're not going to go there. Do I ever see this going mainstream? I do. It's been proven that there's a lot of efficiencies with this, especially with supply chain management, financial settlements, reconciliation. So it will go mainstream. I think now that blockchain has been out there in the popular press for a while, people are interested in it and are learning it about it. That there's going to be more and more adoption. Um, but for some, it won't be right for some organizations, right? You have an ERP system, you have good internal controls, you essentially accomplish the same functionality. But I do think, and I think others see this probably being adopted widely 5-10 years, and it'll probably be adopted larger organizations first, like NASDAQ, IBM, Walmart. Governments are very interested. For example, UAE put all of their imports, their import exports on a blockchain. So governments are very interested as well. So yes, I do see it going mainstream. So realistic use cases today, if any, for accounting. So yes, bank reconciliations. I have my cash balance. The bank has its cash balance. That'd be very easy to do with a blockchain. Um, reconciliation settlement times on transactions. Um, so settlement times on transactions would be accelerated or non-existent, because again, if we have one shared source of the truth and I have assurance that it wasn't changed, then I can say, oh yes, you're wanting to refinance your house. I don't see any other liens. I see that you still have title, all that. Yes, here's the refinance. Here's your money at a and I'll take my fee. Thank you very much. And you have your money for your new boat. If it takes time to sort out the cause of the hash variance, is there not a risk to valid transaction? So yes, so that would delay valid transactions, right? So that would delay valid transactions if they're aggregated in the same block. It would just be that the block proposed, someone say, oh no, I don't agree with everything you're saying. Something within one of the transactions you have in your block is not true. I'm just going to ignore that. And then the next block comes in, and then hopefully the valid transactions are in there. But there would be a risk, there would be a delay if there is a hash variance. You're right, Greg. Do smart contracts really require blockchain? That is a good question. Blockchain has been proposed as the foundation for smart contracts because they're immutable, right? So for any contract, I don't want it to change. If once we agree to the terms and conditions, those are the terms and conditions. So as a because of that, and it's immutable record, and you trust the information coming in from the oracles, blockchain would be the platform for smart contracts. But to directly answer your question, I'm not sure if it's required. So I'd have to think more about that, David. That's a good question. Thank you. Would a charity have any use for this? I think so. So charities often have compliance obligations. So depending on, in the United States, at least where I'm located, they have, if they receive state or federal funding, they're subject to an annual audit, and they have to show that they're not engaging in inappropriate activities. So one of the first audits I was on as a young and naive intern was I did a charity audit, and when I had to go through a sample of receipts to make sure that they weren't spending funds on alcohol. So that was super fun, right? Perfect job for an intern. So I was going through that. Whereas if I had everything on a blockchain, to make it much easier, so it would be potentially a cost savings for the audit there to show compliance. Do you think it's cost effective to be applied in small businesses? Currently, probably not. I mean, there are, so IBM Hyperledger is sort of an open source code for blockchain. So you could actually go out there, pull from the IBM's Hyperledger project to develop your own blockchain. But there would need to be some sort of institutional knowledge of how blockchain works, and then of course how your business works and how you transact with others. It could be something to explore, but I'm not sure its cost effectiveness now because again, it's a new emerging technology, so the skills aren't very widespread yet. So those that have the skills can demand a premium. How do you rank blockchain and distributed ledger technology in terms of their potential influence on accounting and financial reporting, especially when compared to other things like artificial intelligence? So I think blockchain and distributed ledger technology are going to have a bigger impact sooner than artificial intelligence. Artificial intelligence is obviously going to change everything. I mean, everyone's read about Chat GPT and then Google's Bard and how Google, what did they lose? $100 billion in market valuation because Bard made a simple mistake. So I do think that this is coming sooner because if you trust, it's, I guess, more trustworthy. It is code that is executing itself, but it's not learning. It's going to do exactly what you tell it to. And if you have good internal control surrounding the system, it should work as intended. So I would say they're both going to have a big impact, but blockchain and DLT is going to impact our profession sooner. With so much efficiency gains, do you think blockchains will impact employment rate? Many jobs could be obsolete. So you're right. But I mean, we're always innovating. And what we did 10 years ago, 20 years ago is not what we're doing today. So when we had like source data automation, right? So you had barcode scanners and you're scanning that. So people so you got rid of the person looking at the price tag on the item and keying it into the calculator to calculate what we would do, or what we would do, how much it was, so what your total would be. So here, so we're reducing time on settlements, on reconciliations. So it's like with other emerging technologies like RPA and artificial intelligence, the more mundane, simple tasks that we can relegate to code, to if then else rules, are going to be performed by machines. And then what we can do very well, or humans can do very well, that machines can't do currently, not saying they'll never do it, probably in my lifetime they'll be able to, is use their judgment. So use their judgment in situations. So just migrate from those more mechanical tasks to those that are more subjective, I think.
Okay, great. Thank you, Peter. I think we should probably end it there. And it looks like there's a lot of interest in this topic, and you did a fantastic job just laying out, describing how blockchain actually works and the issues with it. And I think, judging by the questions, people got a lot out of it too. So I just wanted to thank you again for taking the time to do the webinar today. And the slides are posted on the website. And I'm hoping you can join us in 6 weeks for another practitioner-focused webinar by Dr. Veliko Fotek on valuation in the metaverse, looking at digital assets and virtual worlds. Then 3 weeks after that, we have a webinar on using best practices in visualization using Python, followed by somebody from a journalist from the ICIJ, the people behind the release of the Panama Papers, who'll be talking about releases of large-scale data online. And lastly, 2 weeks after that, I'll be presenting a webinar on using Python to measure reputational capital. So we have 4 really interesting webinars left this semester. And thanks again for joining us. An email will be sent out automatically to all of you in 1 minute. And thank you again. I hope you have a great weekend. Thanks for joining us.